Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
That's called spread trading, and that will be in a class. Again, I'm giving these back to basic classes in a series. This is the first of 8. This will come later on. I'm seeing more questions roll through. I'm going to answer the rest of the questions at the end of the webinar, and I'll be done in about 10 or 15 minutes. So then I'll answer all your questions. A nice big crowd. I want to thank all of you for attending. And I hope that you stay tuned for all of our webinars. We think we're going to have a great 2010, tons of education. These webinars are always free. So, bookmark us, know when these webinars will be offered. I think you'll learn a lot, and hopefully you'll be able to use this information some point in 2010. The options transfer risk at a price. So I could decide what price is worth it for me. Options are based on risk-reward. Normally, the greater the reward, the greater the risk. These options are cash settled. So again, I don't have to worry about having to deliver, let's say, Swiss francs or Mexican pesos. If I'm trading in those currency pairs, I know that I'm going to trade it in a U.S. dollar account. I have to have a broker here that has access. So if you're outside the U.S., you might want to find a broker that has access from your country into the U.S., and there are many. These options are going to be traded in U.S. dollars, if you will. The premiums are quoted in U.S. dollars, and any sort of cash settlement will be done as a U.S. dollar cash settlement. So there will not be any delivery of another currency. Options can be traded any time the market's open, so we trade these from right now, 9:30 to 4:15 Eastern Time. We're looking for approval to trade a couple hours early, and that might come sometime in the next few months. Premiums are multiplied by 100. So let's say that I look at an option and it's quoted at $1.50. What does that mean? Well, $1.50 times 100 is $150. So essentially, you're going to control about $10,000, depending on the currency pair, that $10,000 currency pair for about $150. Now, every currency pair, you have to do the math. Let's say if the U.S. dollar against the Canadian is trading at 105, that contract's worth $10,500. The dollar against another currency might be, it might differ. Dollar yen might be trading at 93, it's worth 9,300. Option buyers are going to pay for the limited risk. These options are based on probabilities. And of course, we need to always think about risk and reward. So we went through what a call is and what a put is. Calls give me the right to own that exchange rate. Puts give me the right to sell the exchange rate. Okay, very, very important. We know that there's expiration, different months, different strike prices. So I can, if I'm looking at a U.S. dollar Canadian, I might want to look at a 100 call, 103 call, or 105 call. They're all going to cost different amounts because the probability of success is different. The risk reward is different. So the in-the-money is going to have the highest nominal value. The at-the-money will be a bit less. And the out-of-the-money option is going to be the cheapest. Be careful, though. For those of us, and I've been through this many, many years ago, you look at the out-of-the-money options and you say, oh, they're so cheap, I can buy a lot of them. I can control, the exchange rate at a certain higher strike price. I think it's going to go way through there. You got to have reasonable expectations because if you're buying out-of-the-money options, you need to have a bigger move. As I said, expiration. You can buy an option as short as a day. That only happens one day prior to expiration. Expiration is the third Friday of every month, and the options actually expire at 12 o'clock noon Eastern Time. So if you wanted to trade out of them, you have about 2.5 hours on that expiration day. But if you're trading a June option in January, the January expiration doesn't necessarily matter all that much. So we have expirations that go out up to 10 months. I had a question on that. So you can trade anytime in that from 1 to 10 months. You could change your mind. You could buy a 5-month option, and it might start to decay or depreciate a little bit. You might say, I still believe in my forecast. I could sell that and buy a 9-month option. I mean, the opportunities are countless. Generally, as I said, time and price are directly correlated. The more time, the greater the price for an option. Premiums are multiplied by 100. So if I look at an option that costs, let's say it's quoted at the exchange at the ISE at 210, that's going to cost $210. So it's 210 times 100, not including any commissions. And every broker is going to charge you a little bit different. One thing about the ISE, we will never, ever, ever trade with your orders. So you're not trading against us. We're the exchange. Much different than the OTC options where you actually trade against that entity. So we think that there's much more integrity here at the ISE because you're trading against market makers. These market makers are in a business to sort of quote these options against the spot, the futures markets, and they create a very tight market, and their goals are much different than yours and mine. So what's the underlying instrument? It's basically an index. We take the currency pair and we multiply it, in many cases by 100. So the spot values, of course, move in pips. We at the IC created these currency pair values to replicate the movements in the currency market. And options can be traded on most of the popular currencies, and we're always adding more. So if you were looking at the dollar against the Canadian, trading at 105, I know I think it closed 103 something today, but when I built this slide a couple weeks ago, it was 105. 105, all that means is we multiplied 105 by 100 and we get a CDD value of 105. So you could buy a 100 call, 105 call, 110 call. And they're all going to cost different amounts. The spot prices are based on the exchange rates reported by WM Reuters. The rates are scaled using what we call modifiers. So you might have a different modifier in the yen, which is not modified at all, it's just 1. The Mexican peso might be 10, excuse me, and many of the other ones are 100. Remember, at expiration, all options are going to be worth either 0 or their intrinsic value. Prior to expiration, options are going to have some value, some time premium. So it's the likelihood of the underlying moving beyond the selected strike price. So how is this cost determined? You're going to be quoting this. You're going to be trading this. Market makers quote it. Well, you get the intrinsic value. What is the option worth if expiration was to occur immediately? And then you have the extrinsic amount. Let me go through it. So let's just use an example of U.S. dollar Canadian trading 105. I know it's a little bit lower. It's around the 103 range, but let's just say it was 105, and I did this a couple weeks ago where it was 105. If you've lost sound, you can always call in on the number. You can go to communicate and call back in. Okay, so using CDD at 105, the 100 call is going to be the most expensive here. It was quoted at $5.60. The in-the-money amount was $5. Thanks, Alex. Alexander says it's 103 right now. It's 103, 1.03430. So the ISE value is roughly 103.43. So looking at Alexander gives me this value right now. The 100 calls would be down a bit because, again, as the spot moves lower, these options would depreciate. They would go down in value. As the U.S. dollar Canadian moves up, then I would see higher values.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.